Today's markets look calm, but that calm could be misleading producers. Grains held together, livestock exploded higher, and crude oil kept creeping up. And when those pieces don't move in the same direction, someone usually gets caught leaning the wrong way. Today didn't give us answers, it set the trap. Good morning. Thank you for spending your morning with me. This is Boots and Bushels, your daily look at the markets that feed America. Today's trade closed with grains refusing to break, livestock charging higher, and energy quietly adding pressure underneath the entire commodity complex. Nothing blew up, and that's exactly why today matters. Let's walk through what actually closed, what's being ignored, and where the risk is building as we head deeper into February. March corn settled at 428 and a quarter. Corn spent the entire session doing something markets do right before they move. It went quiet. There was no panic selling, but there also wasn't aggressive buying. That tells us end users are covered enough for now, and producers aren't under pressure to force grain into the pipeline. The risk here isn't downside, it's complacency. If demand shows up unexpectedly, there's very little grain being offered at these levels. If it doesn't, corn can drift lower without ever triggering alarms. This market is balanced, and balanced markets don't stay balanced forever. March soybeans settled at 1065 and a half. Beans held firm, but they didn't lead. That's important. Global supplies to cap upside enthusiasm. Even as demand refuses to disappear, South American production remains the shadow over this market. But traders are also aware that logistical delays can shift timing faster than headlines suggest. The pressure point for soybeans isn't price, it's patience. Who blinks first? Buyers waiting for cheaper beans or sellers waiting for confirmation demand won't fade. No confirmed CME Chicago wheat settlement was available at the time of this report, so wheat is not included in today's official recap. April live cattle settled at $241.77, up $2.25. This was not a casual move. Cattle markets continue to trade the same reality: tight supplies, disciplined sellers, and demand that refuses to roll over. Every pullback continues to find buyers faster than expected. The risk here isn't whether cattle are strong, it's whether the market becomes too confident. Strong trends invite volatility, and this market is now priced for very little margin of error. March feeder cattle settled at $368.27, up $1.92. Feeders followed live cattle higher, even with feed costs still in the conversation. That tells us placements remain the dominant driver, not fear. As long as corn stays contained, feeders remain supported, but if feed costs re-enter the spotlight, this is where pressure would show up first. April lean hogs settled at $98.30, up $1.67. Hogs finally caught a bid that stuck. This doesn't erase long-term concerns, but it does signal improving short-term demand and higher nearby supplies. Momentum is shifted, at least for now. The key question is whether buyers stay engaged once the calendar turns. March crude oil settled at $63.84, up 63 cents. Crude continues to grind higher, not explosively but consistently, and that matters. Energy doesn't need to spike to influence agriculture. It just needs to stay elevated long enough to work its way into fuel, fertilizer, and freight. This isn't today's headline, it's tomorrow's cost structure. Weather isn't driving markets yet, but it's setting conditions. Cold pockets across the Midwest continue to limit winter field activity, while South American weather remains the variable traders refuse to fully price. Weather isn't loud right now, but it's still part of every pricing decision being made. In ag news, across grains, today was a waiting game. The absence of selling pressure doesn't equal bullish conviction. It simply means nobody feels forced to act. Markets like this don't reward impatience, they punish assumptions. Cattle strength is no longer isolated, it's influencing sentiment across commodities, reinforcing the idea that supply matters more than forecast. As long as numbers stay tight, livestock will remain the leader, and leaders set the tone. Crude oil doesn't get headlines in ag news until it does. Persistent strength quietly raises the floor under commodity markets and reminds traders that inflation pressure never really leaves. It's not loud, but it's present. In today's close, today's markets didn't break, and that's exactly what makes them dangerous. Grains are balanced, livestock is stretched, energy is firm, and everyone is leaning just a little too comfortably. The question isn't what moves today, it's what moves first next. Thanks again for spending your morning with me. This has been Boots and Bushels, and I'll see you tomorrow.